What major historical shifts shaped the estate tax exemption? Imagine a world where the government could tax your inheritance, but only if your estate was very large. That idea has changed a lot over the years, shaping how much you can pass on tax-free. Let's look at some key moments that made this happen. Back in the late 1700s, the first federal estate taxes were just temporary tools. They were created to help fund wars, like the naval war against France in 1797. These taxes were repealed once the wars ended. During the Civil War, in 1862 and again in 1864, inheritance taxes were introduced to raise money for the war effort. But after the war, they were repealed again. In 1898, a federal legacy tax appeared briefly during the Spanish-American War, but it was gone by 2002. The real turning point came in 1916 when the United States ratified the 16th Amendment. This gave Congress the power to tax income and related transfers, leading to the creation of a permanent estate tax system. From then on, the estate tax grew and changed. In 1924, gift taxes were added, and later, laws included protections for small family farms and businesses. During the 1940s, the estate tax base expanded to include life insurance paid by the deceased and community property interests. The law also allowed spouses to transfer unlimited assets without paying taxes, called the marital deduction. A big shift happened in 1976 when estate and gift taxes were combined into one system. This made planning easier and introduced the generation-skipping transfer tax, which stops wealthy families from avoiding estate taxes by skipping a generation. It also created rules to help small family businesses and farms. In the 1980s and 90s, the law kept evolving. The estate tax exemption was increased, and the unlimited marital deduction was confirmed. New rules were added to help families keep land and businesses, like the qualified family-owned business deduction. In 2001, the Taxpayer Relief Reconciliation Act raised the exemption from $675,000 to $3.5 million by 2009. It also temporarily eliminated the estate tax in 2010, causing a lot of planning uncertainty. Then, the American Taxpayer Relief Act of 2012 made the exemption permanent at $5 million, adjusted for inflation, with a top rate of 40%. This helped stabilize estate planning for many families. In 2017, the Tax Cuts and Jobs Act doubled the exemption to about $11.18 million per person, adjusted for inflation. This meant many estates could pass without paying federal estate taxes. But this change is set to expire at the end of 2025 unless Congress acts again. States also played a role. Many states had their own estate or inheritance taxes, but since the 1920s, fewer states do. This has led some wealthy people to move to states with better laws, influencing estate planning strategies. All these shifts have made estate tax planning more complex. Knowing how the exemption has changed over time helps families and estate planners make smarter decisions. Tools like trusts, lifetime gifts, and marital deductions have evolved to help protect wealth, but staying updated is key to making the most of these options.